Imagine a global marketplace, just enormous. It actually dwarfs the stock market. Trillions of dollars changing hands every single day.
It's truly staggering when you think about the scale.
And it basically never sleeps.
Yeah.
It's running 245, following the sun, London, New York, Tokyo, round and round. This is Forex, currency trading.
Yep, the foreign exchange market, where the value of, say, the US dollar versus the euro or the pound against the yen is constantly shifting.
And it's driven by this really fascinating mix of global forces. So if you've ever looked at this and wondered, how does this actually work? What do I need to know if I'm thinking about this from the US? Well, this deep dive is for you.
That scale we mentioned, it's key. It tells you this isn't some small side market. It's fundamental to how global business works, reflecting big opinions on different economies.
Absolutely. So today we're digging into the sources you gather, the articles, the research, to really pull out the essential info, the basics of currency trading, specifically for potential speculators here in the U.S.
We'll look at what moves these markets, how to handle risk, which is critical, and some basic tools traders use.
Right. The goal is to cut through all the noise, find the key takeaways, and help you feel more informed about what trading currencies from the U.S. actually involves.
Yeah.
Let's unpack it.
Okay.
So we see currencies move all the time. What's really behind those shifts? It can seem pretty complicated.
It can, but your sources really emphasize that it boils down mostly to big picture economics, macroeconomics.
So like the health of a country's economy.
Exactly. A currency's value is fundamentally tied to how healthy and stable people perceive that country or region to be.
The kind of stuff we see in major economic headlines.
Precisely. Those key statistics are watched like hawks. Things like GDP, giving that overall picture of output, though it is backward looking.
Right.
Employment numbers are huge. Retail sales, manufacturing data, those give you a more current pulse. Keeping an eye on an economic calendar is pretty standard practice.
What about inflation? That's everywhere in the news lately.
Yeah, inflation's a tricky one in Forex. Its impact isn't always simple. Rising inflation usually weakens a currency domestically, right? Your money buys less.
Sure.
But, and this is key, if inflation gets too high, the central bank often steps in and hikes interest rates. Significantly sometimes.
Okay.
And higher interest rates, they can actually make that currency more attractive to foreign investors chasing better returns. So paradoxically, it can boost demand for the currency.
Huh. So it really depends on the context, the reaction.
It's a balancing act, yeah.
Beyond these reports, do other markets like stocks or bonds play a role?
Oh, definitely. There's a strong connection. Capital markets, stocks, bonds, commodities, they all signal sentiment about the economic outlook.
How so?
Well, take a country like Canada, heavily reliant on oil exports.
Yep.
If oil prices surge, there's more global demand for Canadian oil.
Meaning people need Canadian dollars to buy it.
Exactly. So that increased demand for the CAD can push its value up. It's correlated. You see similar things with other commodity-linked currencies.
Makes sense. You need the local currency to buy the local stuff. What about international trade itself? Exports, imports?
Fundamental. Trade balance matters a lot. If a country consistently exports more than it imports a trade surplus, foreigners need more of its currency to buy those goods.
Pushing the value up.
Right. Conversely, a big trade deficit means the country is buying lots from overseas, so its residents are constantly selling their own currency to buy foreign currency. That can weigh it down.
And politics. We can't ignore that, surely.
Absolutely not. Political stability, big policy changes, think fiscal spending, trade deals, regulations, even things like leverage rules for trading, they all matter.
Election outcomes.
Yep. Markets often react positively to parties seen as pro-growth or fiscally responsible. And then you have major events like referendums. Think Brexit.
Wow. Yeah, the pound took a massive hit.
Huge impacts. So monitoring political events, especially anything touching on fiscal or monetary policy like central bank interest rate decisions, that's critical. Those decisions are probably the most watched events on the Forex calendar.
So it's this constant evaluation of a nation's economic health, its outlook, seen through data, trade, capital flows, politics.
And you always have to expect the unexpected. It's a complex system. No single thing dictates rates perfectly.
Okay, got it. So that's the big picture.
Okay.
Let's shift gears to the U.S. specifically. If someone here wants to actually trade, what's the regulatory situation like? How do you even pick a broker?
Well, the good news is the U.S. has a pretty robust regulatory framework that extends to retail Forex, and it's there for investor protection and, market integrity.
Who are the main regulators we should know about?
For retail Forex, the sources point mainly to two. The CFTC, that's the Commodity Futures Trading Commission, and especially the NFA, the National Futures Association.
NFA. Why are they particularly important?
Because the NFA sets and enforces a lot of the specific rules for retail Forex brokers serving U.S. clients. Things like how much capital the broker needs to hold, strict limits on the leverage you can use, and making sure brokers provide clear risk warnings.
Are there others involved, like the SEC?
The SEC and FINRA oversee the broader securities markets and broker-dealers. And then there's SIPC, which provides some protection if your brokerage firm fails up to $500 K total with a $250 K limit for cash. But you need to understand exactly what it covers. It doesn't cover trading losses.
Okay, so regulation is clearly step one when looking at a broker.
Absolutely non-negotiable step one. If you're a U.S. resident, you must prioritize brokers regulated by the NFA and CFTC.
What about international brokers? Some have big names.
Even if they're regulated by reputable bodies overseas, like the FCA in the UK or ASIC in Australia, they still have to comply with all U.S. regulations, including NFA registration, to legally serve U.S. clients. Always check that NFA CFTC approval. You can look up their history, too, just to see if there are major red flags.
Good to know. So once you've confirmed they're properly regulated, what else matters when choosing?
Costs are next, especially if you plan to trade actively. This mainly means the spreads and any commissions.
The spread. That's the difference between the buy and sell price.
Exactly. It's basically the broker's built-in fee for the trade. Tighter spreads mean lower costs for you. Some brokers might also charge a separate commission per lot traded. You need to compare the total cost.
Don't just look at the advertised number.
Right. Understand the whole cost structure. Then look at the trading platform itself.
The software you actually use to trade.
Yeah. Is it reliable? Easy to use? Does it have the tools you need? Good charting, real-time data, easy order execution. Many offer standards like MetaTrader 4 or 5. Some integrate with TradingView. Others have their own proprietary platforms.
Check the mobile app too, I guess.
Definitely, if you plan to trade or monitor on the go.
What about minimum deposits and other potential fees?
They vary hugely. Some let you start with almost nothing. Others need a few $1,000s. Also, watch out for non-trading fees, withdrawal fees, inactivity fees. They can add up.
Right.
And finally, check their product list. How many currency pairs do they offer? If you want to trade more exotic pairs, make sure they're available.
Sounds like choosing a broker needs as much research as analyzing the market itself.
It really does. They're your gateway. You need someone reliable and properly regulated. And just remember, as a U.S. client, you might face tighter restrictions, especially on leverage compared to traders elsewhere, because of those NFA rules. Some features, like certain types of social or copy trading, might also be limited for U.S. residents.
Okay, that covers the market drivers and the U.S. broker landscape. But your sources kept hammering home something else: risk management. They called it the golden rule.
It's not just a rule, it's often called the rule. The sources are incredibly clear on this. Something like 90% of trading success boils down to effective risk and money management.
9%. Wow, that's huge. What is this golden rule, simply?
Don't lose money. I know it sounds almost backwards for speculation, right? But the primary focus, especially at first, has to be capital preservation.
Protecting what you have.
Exactly. It's less about hitting that one big winner and more about making sure you can survive the inevitable losses to trade another day.
So how do you actually do that? How does it work in practice?
The absolute most critical decision is deciding how much of your total trading capital you're willing to risk on any single trade.
Okay.
Your sources strongly suggest keeping this very small, like in the range of 1% to maybe 5% max, often closer to 1 or 2%.
Why so small?
Because you will have losing trades. You'll have losing streaks. It's part of trading. If you risk too much on one trade, a few losses in a row can cripple your account. Small risks mean you can absorb those losses and keep trading your strategy.
So before I even think about hitting buy or sell, I need to know my maximum loss for that specific trade idea.
Precisely. That's job number 1 in risk management for a trade. Decide your risk percentage or fixed dollar amount. Then, and this is crucial, figure out how that translates into your position size based on where your stop loss is.
Stop loss. Okay, explain that.
A stop loss order is your pre-planned exit point if the trade moves against you. It's the price where you say, okay, I was wrong about this trade. I'm getting out now to cap my loss.
And you set that before you enter.
Absolutely. You must define it beforehand. It's how you ensure a manageable small loss instead of letting it run into a disaster. Discipline is key here.
So how does the stop loss connect to the position size, the amount you trade?
Position sizing is basically adjusting how much currency you trade, how many lots or units, so that if the price hits your predetermined stop loss, the resulting loss equals your predetermined maximum risk amount, that 1%, 2%, or whatever you decided.
Okay.
The sources give a formula. First, calculate your max risk in dollars, account balance X risk percentage. Let's say $5,000 account, 2% risk equals $100 max risk. Then figure out your stop loss distance in pips. That's a small unit of price movement in Forex.
Right.
Let's say your stop is 25 pips away from your entry.
Right.
Then your risk per pip is max risk divided by stop loss in pips. So 125 pips equals $4 per pip. That tells you how much each pip move should be worth, which then determines your lot size. For instance, $4 per pip might mean trading 0.40 standard lots. You need to calculate this consistently.
So the position size ties together your account size, your risk tolerance, and the specifics of that trade setup, like where the stop loss needs to be.
Exactly. And here's a huge warning from the sources. You never adjust your stop loss location just so you can trade a bigger position size.
Don't let greed dictate the stop.
Never. You place the stop loss based on the logical structure of the market, the technical setup where it makes sense to say, I'm wrong. Then you adjust your position size, so hitting that logical stop only costs you your planned risk amount. Decide what you're comfortable losing first.
That really requires discipline. You also mentioned a daily loss limit, an account stop.
Yes, super important for protecting capital and your mental state. An account stop is a limit on the total amount you're willing to lose across all your trades in a single day or session.
Okay.
If your net losses hit that limit, you stop trading, period, for the day. Example, $10,000 account, maybe a 2% daily stop, equally $200 loss limit. If you lose $200 cumulatively, you log off.
Why is that so critical?
It prevents one bad day from snowballing. Trading after significant losses often leads to emotional decisions, trying to win it back, which usually makes things worse. It forces a break, protects capital, and maintains mental clarity.
So a stop loss for each trade and an overall stop for the day.
That's a solid approach. The trade stop manages the risk of individual ideas. The account stop manages your overall daily exposure and, frankly, your psychological well-being. And another rule, never move your initial stop loss further away from your entry price once the trade is on.
Only move it to reduce risk.
Exactly. As a trade moves in your favor, you might trail the stop up to lock in some profit or get to break even, but never give the trade more room to lose than you initially planned. Don't treat open profits like house money. Protect them.
It really sounds like the whole process starts with defining your exit, your point of failure, before you even get in.
It absolutely should. Your sources actually prioritize it that way. 1, where's a logical entry? 2, where's the logical stop loss for that entry? 3, where's a reasonable profit target? And only then, 4, how much do I allocate? Position size? Risk management isn't separate. It's woven into the entire trade plan.
It's all about controlling that exposure.
Yes. And the sources make a really interesting point. Risk isn't inherently tied to the instrument itself, like Forex versus stocks. It's much more about your knowledge and how tightly you control your money through position sizing and stops. You can actually be more conservative in Forex than stocks if you manage risk properly.
Fascinating. Okay, so drivers, U.S. landscape, critical risk management. How do traders actually spot potential opportunities? Your sources talked about technical analysis.
Right. Technical analysis is basically using historical price charts and trading data to try and predict future price moves.
Looking for patterns.
Patterns, trends, using indicators. The idea is that price action reflects market psychology, and history can sometimes offer clues about the future. It's often used for timing entries and exits, especially for shorter-term trades. It's different from fundamental analysis, which looks at that economic health we discussed earlier.
Can you use both?
Many traders do. They might use fundamentals to get a directional bias and technicals to pinpoint entry and exit points.
What are the most basic technical tools?
Well, the sources start with the charts themselves, usually candlestick charts.
Why candlesticks?
Because unlike a simple line chart, each candle shows you the open, high, low, and closing price for a specific period, like a day, an hour, or even a minute. Plus, the color usually tells you if the price closed higher or lower than it opened. They pack in more information.
And longer time frames are generally more reliable.
Usually, yeah. A pattern on a daily or weekly chart tends to carry more weight than one on a 5-minute chart, especially for identifying major trends.
Okay, charts first. Then what? Support and resistance.
Absolutely fundamental. Think of them like price floors, support, and ceilings, resistance. Support is a level where buyers have historically stepped in, stopping declines. Resistance is where sellers have historically emerged, capping rallies.
And price tends to react there.
Often, yes. Traders watch these levels closely. And an interesting thing happens. If a resistance level is firmly broken, it can often act as a new support level later on. Same idea, if support breaks, it can become resistance.
So they flip roles sometimes. Are there specific candlestick patterns to look for?
Yes, lots of them. Your sources mention a few classics. Like the hammer, you typically see it after a downtrend. It has a small body near the top and a long lower wick.
What does that suggest?
It suggests sellers tried to push the price way down during that period, but buyers fought back hard and pushed it back up near the open before the close. It can hint at a potential bottom or bounce.
And the opposite.
Might be a shooting star. Seen after an uptrend, small body at the bottom, long upper wick. Suggests buyers tried to push higher, but sellers took control by the end of the period. Could signal a potential top or pullback. There are also engulfing patterns, like a bullish engulfing where a big green candle completely covers the previous red one, suggesting strong buying momentum.
Okay. Individual candle clues. What about bigger chart patterns formed over time?
Yeah, those are important too. The head and shoulders pattern is a famous reversal pattern. Looks like a peak, the head, with two lower peaks on either side. Shoulders. If the price breaks below the neckline connecting the lows between those peaks, it's often seen as a sign an uptrend might be ending.
And there's an inverse version for downtrends.
Yep, inverse head and shoulders. Looks like a valley bottom with the two higher troughs beside it. Breaking above that neckline can signal a potential end to a downtrend. Then you have double tops and double bottoms, basically hitting a resistance or support level twice and then reversing.
It really is like reading the story of the battle between buyers and sellers on the chart.
That's a good way to put it. These patterns are visual representations of that struggle. And then you have technical indicators.
These are the mathematical calculations.
Exactly. Usually plotted below or on the price chart, like the RSI, the relative strength index.
Right, the overbought, oversold thing.
That's the traditional interpretation. It's an oscillator moving between 0 and 100. Above 70 is often considered potentially overbought, suggesting a strong run that might be due for a pause. Below 30 is potentially oversold. But traders also look for divergences, like if the price is making new highs, but the RSI isn't, that mismatch can sometimes signal weakening momentum.
Interesting. What about Bollinger Bands?
Bollinger Bands are basically a moving average line with two bands plotted above and below it, usually 2 standard deviations away.
What'd I tell you?
They mainly show volatility. The bands widen when the market's volatile and contract or squeeze when volatility is low. That squeeze is interesting because low volatility often precedes a period of higher volatility, a potential breakout. Price tends to stay within the bands most of the time, but they aren't perfect barriers.
So technical analysis is this whole toolkit for analyzing price visually and mathematically.
Exactly, to try and identify potential trade setups, entry points, exit points. And the sources really stress this, no single pattern or indicator is magic. They all give false signals sometimes.
Which loops back to risk management.
Precisely. That's why you use technical analysis to find a potential setup with a logical place for your stop loss. But your risk management rules dictate how much you actually trade on that setup. Many traders look for multiple technical signals to align, maybe 3-5 things pointing the same way, to increase confidence before committing capital, but always with that stop loss defined.
Okay, this has been a really thorough deep dive into the sources on Forex basics for U.S. speculators.
Yeah, we've covered quite a bit. From the big global forces moving currencies, economics, trade, politics, down to the specifics of U.S. regulation like the CFTC and NFA, and what to look for in a compliant broker. Safety, costs, platform.
And we spent a lot of time, rightly so, based on your sources, on the absolute necessity of risk and money management. That golden rule of preserving capital, how to calculate risk per trade, position sizing, the discipline of using stop losses before entering, and that daily account stop for protection.
Crucial stuff. And then we touched on technical analysis, candlesticks, support resistance, some key patterns and indicators like RSI and Bollinger Bands as tools to help identify and time trades, but always used alongside strict risk control.
It feels like the single biggest message echoed throughout your sources is that while analysis is important, long-term survival and potential success in this market hinges almost entirely on that disciplined, methodical risk management, preserving your capital.
It really is the foundation. It lets you stay in the game long enough for your strategy, whatever it is, to potentially play out over many trades.
So building on all that, here's something to think about. We talked about how deeply connected currency movements are to global economics and politics. So consider this. How might consciously keeping up with major world news, understanding those bigger narratives, actually enhance your perspective or provide context, even if your main focus is technical chart reading. Could awareness of the why behind the moves change how you approach potential trades?
It definitely adds another layer of understanding potentially, seeing the bigger picture behind the price wiggles.
Exactly. Well, hopefully this deep dive into your sources has given you some valuable insights and a clearer framework for understanding the fundamentals of currency trading from a U.S. standpoint. Keep learning, stay disciplined with that risk, and see where your journey takes you.